Hey everybody, Walrus here from Walrus Street, bringing you a DD today on a penny stock, a non-pharmaceutical penny stock. Holy crap, what world is this? The company's called Dynatronics Corporation, the ticker's DYNT, market cap sitting around $22.9 million, and it's trading at about $1.36 a share as of the recording of this video. Microcap companies are really tough because they're microcap for a reason. Typically, their potential for growth is limited. Typically, they don't have a lot of big name investors, or typically they're in very crowded fields. This one, I think, falls into the latter. Dynatronics is a medical equipment supplier specifically for physical therapists and occupational therapists. I haven't done one of these DD videos in a while, so if you're new to my channel and you don't really know how these things work, please watch the video in its entirety. It is meant to be watched as an entire piece so you can understand my opinion at the end of the video. Don't just skip to the end where I tell you what I'm going to do. That's pointless because you don't understand why I'm doing the things that I'm doing. I'm going to be answering 4 primary questions throughout this video. Question number 1, what's the company? What's the product? Question number 2, who's in charge? This would be the C-suite. Question number 3, what are the financials? Question number 4, who else is involved, as in big name investors, funds, that type of thing. This is the company's website, Dynatronics. You could see they're a leading medical device company committed to providing high quality restorative products designed to accelerate achieving optimal health. The company designs, manufactures, and sells a broad range of products for clinical use in physical therapy, rehabilitation, pain management, and athletic training. Great, wonderful. They sell medical devices. Now, the company's products are marketed under a portfolio of high-quality, well-known brands, including Bird & Cronin, Dynatron Solaris, Hausmann, Physician's Choice, and ProTeam, among others. The company, the parent company, is Dynatronics, and they have this big umbrella of other medical supply companies. The big ones would be Bird & Cronin, which makes kind of like soft devices like braces, and Hausmann, which makes furniture for PT clinics, OT clinics, like treatment tables, treatment racks, that type of thing. If we look at their products, you can get an idea of what they sell. Ice packs, we've got ultrasounds, we've got e-stim products, heating covers, moist hot packs, ultrasound gel. You get the idea. Basically anything you need if you've ever gone to a physical therapist. Now, they sell larger equipment and tables through Hausmann specifically, and they even sell traction equipment. Now, one thing I want to look at and mention slightly is Hausmann. Hausmann makes custom products for treatment centers, for athletic treatment centers, physical therapy offices, and occupational therapy offices. I think Hausmann has the opportunity here to be kind of front-running Dynatronics a little bit, and I know it's not very sexy for the furniture wing of the company to be leading the company's revenue, but it might be a reality with the increased lumber prices that we've been seeing driving an increased price in the pieces coming out of Hausmann. Now, one of the things that we need to look at before we even go any further is what's up with the PT market. Is it even an attractive location for an investment? Because I know healthcare can be really kind of touch and go, and healthcare depends on a lot of extrinsic factors, specifically insurance payouts. But PT is growing consistently, and there's going to be a wider future need for PT with obesity rising, with an aging population, and with secondary diseases requiring treatment, musculoskeletal treatment. So the US physical therapy clinics constitute a growing $34 billion industry. That's just in the US alone. This is a fragmented industry, and this is something that's quite important. PT services provide a cost-effective way to prevent short-term disabilities from becoming chronic conditions, to help avoid invasive procedures, to speed recovery from surgery and musculoskeletal injuries, and to eliminate or minimize the need for opioids. And with the opioid crisis in America, you can understand why people would be pushing PT therapy. Also, following surgery, hospital discharge times are record low right now, where people are staying in hospitals for shorter and shorter periods of time, requiring the need for external PT. So that external PT falls on these clinics that have to buy the supplies from companies like Dynatronics. The PT market size is around $34.5 billion, and this is in 2018, but the market is forecast to grow about 6.2% on average. Now, the last couple years with COVID kind of threw off the numbers a little bit, and admittedly, this is stagnating a bit. I would be really surprised if the whole market wasn't over about $38 billion at this point. In the United States, there are an estimated 38,800 clinics that offer physical therapy, occupational therapy, speech therapy, speech therapy and audiology. Early hospital discharge practices foster a greater demand for outpatient physical therapy services. And even though this industry has been consolidating for over 10 years, private practice still remains fragmented. The 20 largest companies, 2 public operators, 8 private equity-backed operations, capture just 21% of the industry's market share. The potential for roll-ups is high. Let me highlight this. The potential for roll-ups is high. This is an incredibly fragmented industry. This actually could be a catalyst for Dynatronics, as I'm going to make an argument for throughout this video, where I believe Dynatronics is getting ready to acquire another large company at this moment. And I say large relatively because it is a micro-cap company, but I think Dynatronics is going to be acquiring another brand very soon. They're rolling up, they're growing by acquiring brands, and Dynatronics, as the parent company, isn't interested in being acquired by somebody else. They're interested in doing the acquiring themselves. The insurance companies have not been kind to PT, but going into the future, they're going to be forced to. Because hospitals are discharging patients earlier, insurance companies have been kind of putting the burden of payment for physical therapy onto the patients. But going into the future, they're going to be forced to start taking up some of that payment themselves with the aging population, with the obesity crisis. So there are several tailwinds for the physical therapy industry, including an aging population, early hospital discharges, and finding safe alternatives to opioids, and high rates of obesity. According to the Urban Institute, the number of Americans aged 65 and older is expected to double over the next 40 years, reaching 80 million. As people age, they tend to lose flexibility, strength, and often their balance. That's right, physical therapy mitigates the risks of falls in older populations, and we know fall risks are a huge factor in morbidity and mortality rates in the elderly. As a result, falls are a common reason seniors require physical therapy. Furthermore, physical therapy has been used for patients with a variety of conditions such as arthritis, Parkinson's, and Alzheimer's. Guess what? Parkinson's, Alzheimer's, and arthritis are also on the rise along with the aging population, and diagnoses for these diseases is increasing disproportionately to the aging population. So there's an increasing need for physical therapy, occupational therapy moving into the future. According to an article published by the American Academy of Orthopedic Surgeons, approximately 50% of Americans are afflicted by a musculoskeletal condition. According to the CDC, the number of Americans with obesity has increased over the past decade, reaching 42.4% of the population. Obesity can contribute to joint pain due to increased stress that the excess body weight puts on joints, muscles, and spinal discs. And right now, if we look at the physical therapists per 100,000 persons, we can see there's a higher concentration of PTs in the New England region, as well as the Mountain West region, and this is caused by various population demographic factors, such as slightly older populations in the New England region and more active populations in the Mountain West. So where we have active populations, where we have old populations, we need PTs. You get the idea. The CAGR for the PT market is sitting around 6%, depending on your source, up to about 6.5% per year going into the future, even towards 2033. While that's not some spectacular CAGR that's just absolutely jaw-dropping, 6 to 6.5% is very respectable for a return on investment. Keep in mind, the CAGR is not directly analogous to the profits that a company would be taking in, especially in an industry that's rife for roll-ups, where a company can start eating greater and greater market share by acquiring other companies. And that's what Dynatronics is putting itself in the position to do. That brings us to question number 2, who's in charge? The CEO and the CFO are both new to the company. The CEO is John Cryer, and John Cryer has only been with the company for a year and 7 months. He was hired as their CFO right at the COVID drop, worked there from March to July, and then he was promoted July 2020 to the president and the CEO. Previous to that, he worked at Breg, which is another medical device company, for 7 years. He worked at Vicent Orthopedic Solutions for 4 years, and he was a senior manager in lead client services, C-suite consulting, life sciences, and healthcare worker at Deloitte for a total of, it looks like, about 8 years here at Deloitte. Norm, I don't know how to say the name, I'm going to say Rogner. Norm Rogner III is their CFO. He is an experienced senior finance executive known for collaborative style, which is going to be really important for the acquisitions. So he joined the company in November 2020. Before that, he was at another medical solutions company for 3 years. Before that, he was at Molex, which is like an electronics company, and they do sell medical devices, for 17 years. The CEO and the CFO, the new leaders to the company, are both experienced in the fields of medical equipment. And when they came to the company, they brought a very radical vision to the company. And this was outlined extensively on the last last earnings report that they gave. Now, I pulled up the transcript of the earnings report, and I'm going to highlight a couple of sections just so you can see the changes that they're making in the company. But in general, the changes are to streamline the company, to emphasize the high gross margin products, and to get rid of everything else. They're quite literally just trimming the fat off the company and streamlining it to cut costs and make it more profitable. We've been planning and executing an ongoing business transformation over the past 9 months while simultaneously dealing with a global pandemic that's impacted our business significantly. We continue to experience gradual reopenings and an uptake in rescheduled procedures at the facilities we serve, and we believe this bodes well for our future growth. Now, I'm not defending them, I'm not going to make excuses for the company, but a lot of PT services and OT services are viewed by both insurance companies and patients alike as elective procedures and elective services. During a pandemic, what do you think happened to almost all of the PT clinics and OT clinics around the world? I'll tell you what, a reduction in the number of patients, which cut into the revenues for these companies for the last couple years. And just recently have we started seeing people starting to go back into the PT clinics. And I'll tell you what, there's going to be an overcorrection now where these PT clinics are eventually going to be inundated with patients that have been putting off their service, putting off their treatment for the last couple of years because of the pandemic. The markets that we serve are large, growing, and fragmented. Dynatronics is building a scalable platform to grow its customer and revenue base and generate sustainable cash flow so that we create value for our shareholders. The industry research indicates the rehabilitation, embracing, and support markets continue to exhibit an attractive growth profile. As I mentioned at the beginning, the statistics of facility reopenings, orthopedic procedures, and other activities that create demand for our products are on the rise. Now, when I talked about streamlining, goal number 1 is driving the sales and growth and better partnering with their customers. To allow us to better accomplish this goal, we're eliminating approximately 1,600 SKUs of low margin, third-party distributed products with annual revenues of approximately 11 million in our rehab segment. These products were low or no growth, carried lower unacceptable margins, and were not our own manufactured products. This is huge. They're cutting out the third-party stuff, they're focusing on their own products, and they're focusing on margin. Cutting out 1,600 items from their catalog? That's nuts, because they're paying storing costs for those products, they're paying shipping costs for those products, they're paying out money to third parties for those products that's helping those companies grow, not Dynatronics itself. This company is quite literally putting itself first in its product catalog moving into the future. They're strengthening their revenue platform and generating cash, focusing on higher margin. Right here, they eliminated $11 million worth of revenues that generated the low margins, and eventually it was going to have a positive impact on our company's gross and EBITDA margins. The shocker here is that the company released guidance in the middle of August saying that their revenue forecasts were going to be about $2 billion higher than expected, and this is even with the $11 million of underperforming goods eliminated from their books. They're also consolidating their facilities and reducing their facility overhead by 40%. They've sold their Tennessee facility, they're eliminating satellite offices in Michigan and Texas, and reducing the Utah facility footprint by 75%. Now you get the idea of what the management is doing with the company. This is pure streamlining, and they're directing the profits into the company, and their management goal is for their gross margin to be over 40%, which is kind of crazy for medical products. And if they end up hitting that, this company is going to be incredibly profitable. Now, for comparison, right now, as of the last earnings report, they were sitting at a gross margin of about 27.9%, which is good, but once they hit that 40%, their revenues are going to be much, much higher. That brings us to question number 3, what are the financials? Now, this is a comparison of them to some of their other medical supply competitors, and this is from Seeking Alpha. The comparison here is being made, I think, by market cap, companies with similar market caps. But one thing I've noticed is that the enterprise value is wrong for Dynatronics. They have less debt than is being reported here, and I don't really know how Seeking Alpha made this mistake, but the Dynatronics enterprise value is actually slightly less than their market cap, but it's pretty close. They're sitting at 193 employees, and this is even after closing their other facilities. I think they've trimmed down from like 200 and something to 193, so this is more efficiency. Also, I do want to say my heart goes out to those employees that did lose their jobs during this. There is a human element of investing that we cannot forget. If a company streamlines its operations, closes facilities, that means people are losing their jobs. And I don't take that lightly when I'm discussing this. I hope you guys do understand that. Now, if we go down here to the profitability, the gross profit margin for Dynatronics is 27.39%. Some of the other companies, you could see them listed right here. The EBITDA margin is negative 3.83%, which they're not really turning a profit right now. now, so that makes sense. But compared to the competitors, holy cow, like this is the only one that's even close to a positive EBITDA margin. The short interest is only 5%, which that's nothing. There's no factor, there's no chance of a short squeeze or anything here. I don't want you guys to think that's this type of play. I find it funny that I have to say that, but people are actually investing in short squeeze targets out of like principle now, and that's like a thesis guiding some investments. Let me clarify this. That's not this. You know, this isn't a short squeeze potential candidate. And in some way, that actually makes this more attractive, because why does a company get shorted? It gets shorted when it's got a bad business model. Nobody's really short on this company. 5%, that's nothing. So I think a lot of institutions look at this company and say, oh yeah, okay, they're on the right track. There's no point shorting them. There was news released on August 10th. There was an investor presentation where the company said it's announcing preliminary fourth quarter sales of around 12.1 million, which is much ahead of the consensus 10.3 million. Like I said earlier, we have substantially completed the optimization initiatives announced on April 22nd as planned. Continued product net sales outpaced our expectations in the fourth quarter, and our bank line was undrawn with a cash position of 6 million June 30th, 2021, up 176% from June 30, 2020. So they've got less debt, they've got bank credit open and available, and they're just not using it. Also, they mentioned customer and dealer reactions to Dynatronics optimization has been strong, and early results have exceeded our base case expectation. We're continuing to validate our value proposition to customers as we set up for a future sustainable long-term growth and increased shareholder value. This is on their company's shareholder presentation from August, and I want to highlight something here. They're focusing on targeting acquisitions in existing or adjacent markets with customer uptake. They're looking at bringing in new customers through acquisitions. They have 6.1 million cash on hand. They're getting money from the sale of their other facilities, and 100% of their Paycheck Protection Program PPP loan from the government was forgiven, so they don't even have to pay that back. Financially, this company is in great shape. 12.1 million total net sales in quarter 4 fiscal year 2021. Keep in mind, the market cap for the company is only 23 million. So in one quarter, they're pulling in almost half their market cap in net sales. And the company anticipates recording up to approximately 1.2 million in costs as a result of their restructuring activities. So they do have some increased costs temporarily, but that's going to go back down in the future. They're saying the bracing market is increasing at about 6.5% CAGR, which is in line what I saw with the general PT market, and rehab is about 5.3% CAGR increase, which again, that's in line with what I found for the general PT market. So these numbers in this report seem very reasonable. Now they have an M&A strategy for acquisition growth opportunities in a fragmented market to add scale. They're looking for gross margins over 40%, and this is in line with what they're doing in-house already. They're looking for cash flow contributions within the first year from the companies they acquire, and for them to be well-known brands. This is perhaps the biggest, I think, appeal for the company. Shares are trading at 0.4 times EV, enterprise value, to revenues versus peer group of 3.6 times. Now, the peer group would be the USPH, Zixi, Vive, OMI, IMAC, Kids, KRMD, which are different medical providers that are larger in scale, but Dynatronics is trading at a huge discount to revenues of their enterprise value, and they have cash flow from their operations, and they're sitting on no debt. They're reporting no debt here. Now, I did find they have some long-term debt, but it's not even an issue with their current cash flow. Here's some of their business partners. You have Bragg, some of the other hospitals. You have the US speed skating team, the Alabama Crimson Tide. Roll Tide. Oh, it hurts me to say that as a Gator. Oakland Raiders, Minnesota Vikings, Ohio State Buckeyes, Chargers, Unity Point Health, the Dallas Cowboys, the Boston Red Sox. Their customers are like, you know, professional sports teams and healthcare providers. Now at the end here, their market cap is about 25.8 million. They're sitting on 6.1 million in cash. Their enterprise value is about 19.7 million. The enterprise value being this close to their market cap means they're using their cash very effectively. Now on Simply Wall Street, they're giving them a high financial health and a pretty bright future. Now, when you're looking at a company to see if it's of value, it's always a good idea to take a look at the return on equity and the return on capital employed. Return on equity here, it's negative because the company is not really turning a substantial profit. And the return on capital employed is down again, but this is mostly due to the restructuring. Debt, not even an issue. Let's take a look at some of the metrics here on Finviz. The price to sales ratio 0.5 is very low. Price to book 1.4, also very low. The company's company's got 15.8 million shares outstanding, 12.9 million float. Insider ownership's at 19%. Insider transactions are not showing up on Finviz, but I found them on Fintel, and the insiders are still buying in the last 3 months. So this percent should be increasing. It's just not tracking on Finviz. And institutional ownership is 7.9%, also increasing over the last 3 months. Institutional transactions are up 15.98%. Now here we're actually getting an ROE number of negative 33.9%, but there's no net income, so I'm not really sure how Finviz is deriving this number. Either way. That brings us to question number 4. Who else is involved? So on a small cap company, you really want to see the insiders buying the company because the company quite simply doesn't have a lot of name recognition for the larger institutions and for the general public. And what we see, if we scroll down for the transaction history for insiders, these are just awards for some of the C-suite, whatever. But past that, we've got purchase, taxes and awards, purchase, all the way through the beginning of the year. In fact, I can't even find a sale on here for the insiders. Oh, okay, here, back in 2018. Come on. This is all purchases from the insiders. With Dynatronics, it's not just the insiders, but it's also the institutions increasing their shares. We've got B of A, Parrot Ultra Microcap, Vanguard Extended Market, Blackstone, Morgan Stanley, Two Sigma, Parrot. If you take a look at the shares changed and the number of shares, most of these are positive positions adding into their position. Let's go to the top institutional holders. This is on Yahoo. They're reporting 25% shares held by all insiders and 7.9% by institutions, which makes it 10.6% of the float held by institutions. The largest holder at Renaissance Technologies, followed by Vanguard, Parrot Capital, Albion, SquarePoint, Advisor, Geode, Two Sigma, B of A, and BlackRock. Some repetitions here for the mutual fund holders with the addition of Fidelity. I mean, this seems like a lot of positives, so what's the negative here? As with all of my videos, I do like to talk about the positives and the negatives. Now, back on May 19th, the company filed an S3 with the SEC to sell shares up to about $50 million. Keep in mind the company's market cap is only $23 million. This is a value of shares that's doubling up the market cap of the company. To date, out of that $50 million of possible stock they could issue, the company has sold 2.3 million shares of common stock at an average price of $1.61 per share. Net proceeds from the sale of the shares giving the company $3.5 million. So they sold at an average price of $1.61, 2.3 million shares so far. Now, if we take that 2.3 million shares at $1.61, we can see that the company has used up about $3.7 million out of that $50 million possible for the share sale on the S3. The company is being very judicious with this offering, and they're not trying to dilute their shares like crazy. They're just using this money to pay off their debt and to finance their business transformation and make it more streamlined. But here's the kicker. The company just filed another addendum to the S3 saying they're going to be selling more shares, not more than the original 50 million, but more starting on Friday. This addendum here is for up to 2,677,997. If we take this total and we divide it by the $1.38 after hours trading on Friday, which is, when this addendum was filed, we get about 1.9 million shares. So this means the company is going to be having about 1.9 million more shares outstanding. And this, of course, is going to be diluting the share price, but there's something really, really interesting going on here. If we take a look at their chart on Webull, we can see a couple of things. Right now, we're trading at about the middle of a channel. We are on an ascending triangle. About $1 seems to be a very strong support here. Most of the institutional buying took place around $1.10, $1.11. So we're above the institutional point. We're above the dollar share price floor, which seems to be the floor right now. And right around middle of August, there was a huge share spike, and this followed the news that the company increased their guidance for Q4, that they would be making about $12 billion in net sales in Q4. The share price ended up popping up the next day to $1.72 before settling back down the week thereafter. So what's going on? We've been rising in. Why did the company file that form on Friday, right the week before they were reporting their earnings? My thinking is that the company released that PR that they were going to be increasing guidance to test the waters in the middle of August and see how much their share price would go up off news that they were going to be beating. I suspect that with the timing of filing the additional shares to be sold on Friday, that the company is going to be selling shares this week. They filed on Friday so people would forget about it over the weekend to mitigate the damage and the losses going into Monday so the sell-off wouldn't be very extreme. They're going to be reporting their earnings this Thursday. And on Thursday earnings, I'm expecting them to beat their updated guidance. This is going to drive the share price up, and then the company is going to sell most of their shares off of the rise following their earnings price. I really think they were testing the waters with that mid-August earnings report. So I think there's going to be a bit of a rise and then a dump later this week when the company floods the market with another 2 million shares just to sell and bring down the price. Now, this is smart for the company because they're going to be raising more capital, and this is going to be allowing for a short-term trade opportunity here on the stock. Now, all of these things make sense given the past history of the company. Let's do a little SWOT analysis: strengths, weaknesses, opportunities, threats. Strengths. The company is in a very fragmented market, and it is the shark. It is the company that's looking to acquire other companies. I would rather be the company that's acquiring other companies in a fragmented market than the acquiree, because unlike tech, where companies are acquired at a premium and shareholders are getting paid out a large sum of money, in the healthcare field, that doesn't really happen. There's a very small premium on an acquisition, if there's a premium at all. I'm not talking about pharmaceuticals, I'm talking about equipment suppliers. I would rather be the acquirer, and that is a strength of this company. Another strength seems to be the leadership. These guys have been in the industry for a really long time, and they have the business connections to make things work. They're streamlining the business. The new corporate structure looks fantastic. Some of the weaknesses. The weaknesses are, again, the fragmented field, and I know this is kind of strange because how can something be a strength and a weakness at the same time? But it can be a weakness in the fact that there is a lot of competition. So Dynatronics really has to distinguish itself, and they're going to be doing so by focusing on the high gross margin items that will allow them to use their capital more efficiently in business acquisitions. And I can see this as being a roll-up company that grows very rapidly through acquisitions. Opportunities. So the opportunities are the external factors. Opportunities here, the company has very low debt, which is technically an internal factor, but this gives the opportunity for expansion in the market. Opportunities are providing itself in the growing physical therapy market. I really think there's going to be a big opportunity in the influx of customers going into physical therapy after neglecting their treatment for the last couple years. Also, we have an aging population. An aging population requires physical therapy, occupational therapy to keep healthy, to keep moving. Threats. What are some of the threats here for the company? One of them is the finances. Externally, the company is relying on the high gross margin items. If there's a problem with one of their high gross margin items, then the company's going to be losing out because they've thinned down their catalog a lot. So market changes are a threat. Another threat would be COVID. COVID has just killed amount of people that are seeking physical therapy treatment, seeking secondary treatment outside of hospitals since the onset of the pandemic. If for some reason COVID sticks around for a really long time and we get variant after variant after variant, this is really going to limit and dampen the growth potential of the physical therapy, occupational therapy industries, which is going to limit and dampen the sales for Dynatronics. Another threat is actually the insurance providers. If insurance providers don't get on board with the necessity of therapy as a type of treatment, then there's going to be a really big problem here because we need insurance providers to start recognizing the fact that hospitals are discharging patients earlier and patients are seeking treatment at physical therapy clinics, and to start paying for that in order for there to be wider adoption. What's my plan? Let's take a look at the technicals very quickly. We can see that we are in an uptrend. We could see the RSI is kind of in the middle. The MACD is a little bit high. Technicals are showing this isn't like the greatest opportunity. We might be able to get a little consolidation here around 125 for a buy-in, but I mean, on a penny stock, we're quibbling here on something like this. Worth noting, volume is pretty darn low right now. My plan is just to grab maybe a couple hundred shares and try to trade this earnings report because I think the company tested the waters earlier, and the reason they're going to be selling selling these shares this week is because they know there's going to be a pop on earnings. I think they're going to beat the guidance they released this week, and then the share price is going to pop, and then it's going to come back down as they flood the market with another 2 million shares. So I'm going to try to beat the company to my sale of my position. Afterwards, I'm going to wait for the share price to kind of come down and consolidate around that $1.20, $1.25 level, and then I'll be increasing my position size. And I think I want to go into this with a full-size position for a penny stock, which is about 1,000 shares for me. This is tough because I didn't really want to open up a new position on anything lately because I feel like the market's going to be a little bit unstable and that everything's kind of going to go down. I think this is going to kind of hold. At worst, it's probably going to go down to that $1.11 level, $1.10 level where the institutions bought up. But at best, who knows? Maybe we get up to about $2. I don't do price targets, but the analysts, there's 3 analysts covering the company, 1 strong buy, 2 buys. Average price, low end is $1.65, high end is $2.25. So you get the idea. We're below analyst expectation for the next 12 months. Now, this is not a sexy play. This isn't a biopharma that's getting FDA approval and it's going to have some huge pop. This is going to be a more consistent play. I think this could potentially be a long-term play for the company's turnaround to get where it's at, but with no debt, I don't know. I kind of like this one. Now, the only thing that scares me here, and this is probably another weakness of the company, the $50 million in authorized share sales the company has been ready for. But they've been very judicious with the share sales, and I think they're pocketing that money for another acquisition. I think that's going to be the sole goal for that $50 million. They're just going to be using the money on acquisitions. Now, another thing that's worth noting is the CEO pay and the CFO pay. It's linked to the company's EBITDA and revenue growth. If the company's EBITDA and revenue don't grow, then the CEO and the CFO don't get pay raises. And they're actually getting paid very little, mostly in just stock options and awards. So I like that structure. All in all, I would say this is not one that I'm super confident in, but it is a penny stock with growth potential that is not a biopharma company, and it is in medical in a growing field. And I like it for those reasons. Hope you guys did enjoy the video today. If you want to support the channel, check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the content, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe, good luck investing, and I'll see you next time.